Hello and welcome to episode 20 of Frankly Finance. So I'm Gemma Mitchell. I'm usually joined by Lexi Smith from Moneyvine, but Lexi's been on a cruise for the last 2 weeks and now she's got COVID. So her whole house is actually really sick. If the kids weren't sick, she could probably join. But yeah, so Lexi's not here. So we've got Thabojan stepping in again, which I'm so grateful for. And last session was awesome. So very glad to have you back.
Yeah, so cool to be back again, Jim. I'm making a habit of this.
We'll kick Lexi off. She'll be replaced in no time.
I don't think I can do that. But
Okay, so on today's topic, we're going to be talking about family finances, but from a perspective of like extended family. So thinking outside of your standard family life, like a de facto relationship or husband and wife, vice versa, all that kind of stuff. So more like with parents, perhaps with siblings, and we'll probably be talking about where these are strategic moves that you actually planned around or they're accidental. You've kind of just fallen into this arrangement and the complexities and that kind of stuff that go along with it. And Thabojan and I were just chatting before, and we do actually have some examples from clients that we've dealt with that we can go through as well. So we're going to talk about it pretty generally. We've got some questions that have already come in. So if anyone's watching live and you've got questions, please pop them in. And then I've got some from my Instagram as well. So yeah, we'll jump into it. But do you want to start? What are your thoughts around this topic and where we should start?
yeah, such a good topic and so important, and so many things that can go wrong, right? You've seen them, I've seen them, the catastrophes, and I'm not overstating that, the catastrophes that can happen when we accidentally do things, usually with the right intentions, but don't think through all the implications because, we've never had to do it before and it sounds like a good idea, but without thinking through it with someone who has seen those scenarios so many times, just to point out where things can go wrong and where they can go right. And then, like all good planning, making sure that you understand what could happen and then being comfortable with whatever happens.
Yeah. And I think people probably think, oh, yeah, what could go wrong from a financial perspective? But often it's the knock-on effects of that, like the breakdown in the family relationships. Like so many of family breakdowns and relationship breakdowns are because of money, because it's such a stressful part of life that touches every part of your life, really, when you think about it. So, yeah, when I think about the horror stories that I've heard around this, it's not that the financial investment or whatever they didn't work out. It's that it's taken a turn and it's the relationship that they've lost. And, can you put a price on that? So, yes, we've got to consider the structure, the tax, all of that. Is it a good idea from that perspective? But also, is this going to cause major rifts in a relationship that are going to be irreparable? Which is sad.
Yeah, absolutely. Yeah. As we know, it's the relationships. It's our relationships are more important than money for most of us as well. Yeah. So that's why that causes
a lot to lose. Yeah.
Okay,
well, should we get into it with an example? Do you want to go through that and then we can kind of talk about different structures?
Yeah. I've got a couple of examples. I know you do too. It's quite topical. There's a couple of people I've helped. Obviously, we won't use their names for privacy, but a couple of families that are going through some challenges. And so the one most recent is a family and multiple siblings, and then we have elderly parents, and one of the siblings needs financial help. And, how do the parents help in the right way, but then also be fair with everyone?
Yeah.
That's part of it. How do we keep equity?
That can play on the parents' minds as well. Because I know when I've had financial planning clients, they're like, it's stuck that they're like, oh, at this point in time, we gave X child this, like, one of the 3 kids, we need to even it up. Like that can put a lot of pressure on them as well, feeling like they need to make sure it's going to be even.
Yeah, that's right. And I think as a general principle, what I've found is that there's no right or wrong, but in my view, mum and dad need to be clear about what their philosophy on how they want to give money to their children, whether it's through a will or whether it's along the way. And the parents help kids along the way in many ways. It doesn't even have to be financial, along the way and when they're not there anymore. And I think they need to be very clear and at least think proactively about what their philosophy is. Some people say everything always has to be even. Other people say we will help the ones that need it most when they need it. And if we help one more than the other, well, we did that because that's what they needed. And the others didn't need it. And for them, that's okay. But another couple with the same financial position might say, no, everyone's equal share. It doesn't matter who needs more. And so I think parents need to be clear on what their philosophy is. And ideally, they communicate it to the kids as well.
Yeah. And if you come from a family that you're looking at the equity side, not the equal, so like that other people need a leg up more so than other people, and we all come from different resources. So if you look like from that perspective, which I actually love, you would want to be talking to your kids about that. Like for a long time, I would expect, like, we're going to help you when you need it and how you need it, and it's not necessarily going to be equal. And I would expect that that's a conversation that your family has, and maybe then the beliefs and things that the kids also instill. So it's much easier for them to not expect it all to be equal. But yeah, the communication is just so important. And that's, when things go wrong with estates as well, is because people expected that they were getting X or whatever, and it wasn't communicated, and it's a shock to them when it happens. So like anything, communication is absolutely key if you're going to be doing anything in a relationship with finances and assets.
Yeah, 100%. I mean, I don't think hardly anyone has those conversations, and it's uncomfortable, but when you see what can go wrong, you realize that little bit of discomfort is so worth it, because you want to have those uncomfortable discussions where, one child and the other child might disagree on whether it's equality or equity, but that disagreement's better to have when mum and dad are there and mum and dad just go, well, that's the way we're doing it, right? Whereas if it happens after they're gone, then they don't get to say what their thing is, and then the kids are arguing about which way it should go, and no one's right because they're both valid. Yeah. So, I mean, that's probably a massive takeaway from I don't even have to go into the example in any more detail. That's probably the biggest issue, and there's lots of different things that come into it, like the technical side. Like, if you're going to give money to one child, do you have a loan agreement in place? Is it reflected in the will? Does everyone agree with it as well? Because even if this is again the communication, if you don't tell everybody, you can tell someone, oh, I'm loaning you the money. They have to believe that it's a loan. Everyone else needs to believe that it's a loan. And then you want to have a formal agreement, because otherwise they might say, yeah, they said it was a loan, but it's not really.
Yeah, I do actually remember I was in a really fortunate position when I was younger. I wanted to buy a house quite young. And I remember Dad and his partner lent me $20,000. And they got it drawn up by lawyers, and it had a repayment plan, because, if it's a loan but there's no actual repayment structure, it can be not seen as. So we actually did it really, really formally, and we had these things, and my brother and sister had to be aware of it, and then it was put in the will so that if something happened, like, that came out of my slice. And then when it was paid back, we had to change it all again. Like, there was so much to it. But this was before I was a financial advisor. So, like, kudos to my dad for actually going, one, that they were in a position to do it, but then actually looking into the legal and doing it all properly. Like, that would have, now that I'm thinking about it, that would have been an expensive step for them to do, but so important when I've got brothers and sisters and stepbrothers and sisters. And
so good that he did that. Yeah, that's massive.
Yeah. And then I think I paid it back straight away because I realised I was never going to be able to buy a house. But anyway, so there's things like the structure. Is it a gift? Is it a loan? How are they helping? It's the risks, and do they outweigh the benefit? And it's the communication. And then there's like all that legal side, that how do you actually make it legally standing?
The other big one connected, Gemma, is parents sometimes want to help their kids to do because they love them. But I so often see parents, well, firstly, they shouldn't do it because they need the money.
Yes.
And they think, oh, I'll just give it to them, we'll be fine. But them not being fine means that the kids are going to have to bail them out at some point. So the parents have to be sure that this is something that we can afford to do, number one. Secondly, you would have seen this again, parents giving too much to children can actually be bad for the children because they never learn how to manage money properly. And they go, we're just going to get money from mum and dad easy. And then all of a sudden they're in terrible financial shape because they've never had to take responsibility. So they're important things to think about.
Yeah, you can be encouraging bad habits and propelling bad financial decisions. Absolutely. But yeah, I agree with that one. It's like the parents, I've seen it a lot, parents wanting to help and they're just not in a position to, or they see that other people are doing that, that's what their friends are helping and they just so want to do that. But you've got to put your own life mask on or, whatever it's called. Yeah, you're not always going to be able to do that. And I think parents can feel a lot of pressure and they can feel a lot of pressure from the kids as well, from what they want to be doing. But from the kids, like so much talk about, oh, just be a guarantor to help the kids get into a house. But there's huge risks that go with that. And if you've got 3 kids or 2, whatever, are you able to do that for all of them? And what if, you can't then get off as a guarantor to help the next child? And so it's not always handing over money to help. It's giving resources and access to other things in different ways. But there's so many knock-on effects that can ruin relationships and that cause financial hardship to both parties. Yeah, so it doesn't have to be just the exchange of cash. But I used to talk to clients as well about, yes, you want to give them this money or whatever, that's your goal, but do you realize you will lose financial control over that? And you can't then make them do what you want with it, or, you can't have all these strings attached to gifting something. So you have to be okay if they're going to make bad choices or get divorced, right? Like you're gifting this money. And then what if their relationship goes pear-shaped and you see half or more than half of your money? Like once you hand over that power, it's gone, right?
Yeah, that's it. And again, a similar connected one is parents wanting to help their children again buy a house, classic example. And when we've had clients doing this, you can talk them through it, but you go, okay, so why do you need to help them? Oh, because they haven't got enough income to get a loan themselves, right?
Yeah.
And then the question's like, hang on a sec, so you're going to give them money so they can go and buy a house and get a loan that they can't afford?
Yeah.
Are you actually helping them, or are
Yeah.
you putting a noose around their neck with this mortgage that they can't afford? That's why they can't get it.
Yeah. Yeah. But it just comes down to what the parents want to do, what the kids do, and where the pressure is coming from that. I guess we could even push it in, well, it could actually fall into like the elder abuse kind of area as well, that parent, are feeling so pressured to be able to help and they'll do any means possible at their own detriment. I think you've got to be really careful with that. But I think, is it banks when, so I have to check because I haven't done lending for ages, but when you do a parent guarantor, they have to get independent financial advice and legal advice. I'm pretty sure. Oh, no, it's a reverse mortgage.
Yeah, I think that's for a reverse mortgage.
Yeah, reverse mortgage. You've got to be an
Should.
advisor.
I mean, we would agree that before banks do anything, they should ask their customers to get financial advice or some sort of thing. For an example, recently, where a lady who is 55 and not even working was given a loan for like $500,000 to buy a new house.
Yeah.
And I was like, what's going on?
Yeah. Yeah, well, they used to shorten the, like, if you've got a 30-year loan, they used to, I remember they would shorten the time frame, or the lender would have to put a story, like a file note going, well, this is the exit strategy at this age they can access super, or at this age, But yes, there's a lot of things, questionable, responsible lending out there. We got a comment come through from Joy saying, what do you guys think about strategies where you're like matching dollar for dollar to help kids save on their own? So Lexi and I went through this a couple of episodes back where we talked about kids and money and things. But this is a really good question. And I think with this, it's like a strategy that you talk to the kids about. And if you can afford to do that and you're happy to do that, and that's encouraging a good behavior, right? That's actually how I got my first car. My parents were like, whatever you save, we will match. So of course I went like crazy with the savings. So yeah, whichever strategy you feel comfortable with. And obviously with that one, you go into that agreement with them and with the incentive, knowing that, well, if they do that and I can afford to, I'm going to hand it over, and then that's their responsibility. But, you know, I think if you're encouraging good habits, that's a great thing. What do you think, Thabojan?
Yeah, definitely. Whether it's matching dollar for dollar or, our kids are only, 11 and 8. So they're very young. So they've just got their piggy banks. But we've recently set up bank accounts for them. So, and then I said, look, the bank's not going to pay you any interest on it. But what I'm going to do is I'm going to sit down and calculate interest and explain it to you so that they understand the idea of what interest is. And, so if I leave money in there, I get free money, right? So, but yeah, matching dollar for dollar is great for possibly older kids that want to save for something, or even younger ones. But to encourage that saving, encourage those good behaviors, because that's what's missing, right? The financial literacies we really should.
And with that strategy or any, like, Joy, at least you're speaking to the kids, right, about it, and you're having regular conversations, because most of the time that we see the issues with financial literacy is because it's not talked about. So, and it doesn't have to be like a whiteboard session like every month. It can be, 2 minutes here, throwaway comment here, and they're just learning along the way. And that's the same with even older kids as well. Like, they might not want to sit down and learn about how mortgages work or how tax, but if you just chat to them every now and then, like just a throwaway line, a little conversation, they're taking it all in. So yeah, it doesn't have to just be for little kids. It can be for older kids as well. Maybe you talk about your will just off not a serious conversation, but you just go, I've got to renew my will, or, and just little comments. So when you have to have a big conversation, it's not as awkward, because like you've set the foundations that it's okay to talk about money.
Yeah, definitely. I mean, little things like, I know, again, with our kids, we kind of go, if we buy ice cream for the milk bar, we remind them, hey, yeah, it costs $5 from the milk bar, but we know that at Coles we can buy 4 ice creams for the same price. And the kids now tell us that. They kind of go, I don't know, why don't we go to Coles? We can get 4 instead of 1. So just simple spending habits, I think, it's just smart, being smart with money, right?
Yeah, absolutely. So one of the examples that I had recently with a client was, they had both, I can't remember the exact details, but you'll get the point. But they'd both inherited money, and one of the siblings had, like 10 years ago or something, one of the siblings had lent the money to the other sibling so that they could buy a house to live in. And they had an agreement drawn up, great, that they would repay the money at some stage. I don't think the agreement was all that clear on what the money would be worth, like an interest rate, regular payments, all of that kind of stuff. But it's pretty much got to the point where the other sibling's like, hey, I want my money back. This is how much it would be worth. Because it's the primary residence that the sibling bought, they're not in a position to borrow to get that out, or to sell it to get that out. And it's just got really, really messy. And it just breaks my heart, because it's affecting kids' birthday parties and family dinners and all of this stuff, because this is lingering. But yeah, so you just see how many knock-on effects. And then, you have a look at the opportunity cost that the sibling that gifted it lost out on over that time, that they could have been doing something. The sibling that bought the asset, it's grown in value, and they just weren't super clear. Even though they did the right thing, had an agreement, and it was with good intentions, they weren't very clear on an exit plan and the interest and all of that kind of stuff, and it just makes it so messy. So I think the structure and the exit plan is so important. Where I see most of this stuff going wrong, like in this example, is it's pretty straightforward when it's just you to consider. But say, like, in 10 years' time, you might then be married with kids, and you've got a partner that now you need to consider their thoughts and feelings on, do we need that money? Do we, like, it changes the whole conversation when it's not just 2 siblings, but now it's extended families.
And I think that the simplest way to think through it whenever this stuff's going on, I guess it's like risk management with anything. What could go wrong here? And if that went wrong, would we be okay? So with the family lending, it's, what if they couldn't repay me back?
Yeah.
Am I okay with that?
Yeah. And would I be okay having a relationship if I never saw that money again, or would I be super resentful?
Yeah.
Yeah, and as I said, like, how you feel about it at one point in time, it might not mean much to you. You might but then your situation changes, your family dynamic changes, your health changes. That also changes that thought and feeling. Yeah, just so many risks and benefits to weigh up. But then, there are strategies that I kind of think, well, if there's an opportunity to go into an investment with like a sibling or someone that you couldn't do yourself, and you've got similar goals and you are both on the same page about the exit strategy and the risks and whose responsibility is what and the liability on each of you, then it can make a great idea, because maybe you communicate so much better with your sibling than you would somebody else. So it can be a great idea as well if you've done all the groundwork and you've got your strategy. Solid strategy.
Yeah. Although, I mean, it can be great. Although I rarely see it working well like that. So
I don't think I've ever seen it.
Like, I like the idea of it, but I can think of something. I can think of one example where, we've got a couple of clients. They're both brothers. Father passed away, left them with some investments in a trust. The brothers are similar age, similar jobs, both married, both with 2 kids, similar ages, stages, all that sort of stuff, right? And they were like, yeah, we'll just do this. We'll just keep this together, right? It's all good. But then when we started going through individually, what's important to you and your family? What are you trying to achieve? Where are you headed? What decisions are you going to... Then we started picking up on different things they wanted to do in their lives. And they are the ones that said, oh, actually, maybe we should just take our money and do what we want to do with it because for our own families, right?
And then you have control. Mediation. You need to mediate before you make the decision so that you're not backpedaling and doing dispute like resolution. But that's exactly right. Like, you need to drill down on it so much further, and then most of the time people would probably come to their own conclusion that, oh, this is going to get messy and we're not aligned.
Yeah. And the other example I've seen is, self-managed super funds. I think members can now be 6 members in a fund now, et cetera, et cetera. And a lot of people are like, oh, yeah, that's great. You can have lots of people in a fund and pool your money and, but the investments of the fund have to suit everybody. Like, you've got to design your investment strategy based on the outcomes you want from it. And there was one client I saw where he was in a super fund with his business partner and the landlord of the building that they ran their businesses through. And they were all in the self-managed super fund together. One of them was an accountant, and I was like, how does this work? Yeah. And very, very quickly it became obvious that, the investment strategy is just invest it, but don't worry about the objectives of the individual members. Actually, I think one of the assets of the fund was the building that they were
as well
using to work out of, which is legally okay because it's a business asset. But from your house is going to help you with your retirement. They're different ages, different stages. So,
it doesn't make. A lot of the time it doesn't make sense. So I guess the main assets that's a good point of where people combined that can kind of go wrong. So it's SMSF, absolutely. It can be when people buy property together, which we've talked about scenarios, lending money. I was thinking the other one is also around like businesses, like farming or agricultural businesses when they are inherited or passed on, or the siblings take over from the parents and then their objectives don't align as well, or the management styles and all of that kind of stuff. That is an asset. Like that's a business asset, right? Like any financial decision, that can start going really pear-shaped when there's more people in control and it's kind of changed hands.
Farming is a really complicated one because you can have a farm that's been in the family for generations, and you might have one, and particularly in farming families, not every, these days, one of the kids or a couple of the kids might say, oh, I don't want to be a farmer, I want to go to the city or whatever, right? But there might be one or two that go, oh, we're going to continue with the family business, we're going to continue with the farm, and that's what mum and dad wanted, is that one of us do it. But having a farm that's worth $5 million, for example, the farmer child is not actually benefiting from it because they're going to keep it for the next, you know what I mean?
Yeah, it's that is just so messy. Yeah, I was thinking that because yeah, the assets in all of their names. One person is actually managing it and living and breathing that, and the others kind of go off. And that happens as well in businesses, right? It could fall on one child's hands to keep running the business, and the other kids are just like, absolutely no interest in it, which is a lot of pressure for the person taking it over. And I see with retired couples retiring as well, that they want one of their kids to take over the family business, and the kids just don't want to do it. They have no interest in it. And it's heartbreaking for the parent, because they had these hopes and dreams that they're pushing on the kids, and well done for the kids for pushing back and going, it's not my dream. But you just see how heartbroken they are that they've built this legacy that they had big dreams for, and it's just not the wishes of the kids.
Yeah, geez, we could talk for ages about
parents. I'm thinking about so many examples. But so in this episode, we really just talked about, well, hopefully we just raised awareness to people that are considering doing these different strategies. We haven't got into it. We haven't told you exactly what to do or how to navigate this. I just hope we've made you realize that there's so many other considerations apart from what your goal is right now, and that there's risks involved. There's legal, financial advice, any strategy that you're seriously considering about this. I urge you to really, really think about it. Do some mediation around it, if that's with a financial advisor or somebody else. But you honestly can't over prepare for a situation like that. As we've seen, like I gave an example that it could work out well, but in reality, we've never seen that. So I'm hopeful, but yeah, we've only brought up issues. So yeah, hopefully the takeout here is that there's just so much due diligence that you need to do around it, and that the family relationships are so much more important.
Yeah, there's more to lose by getting it wrong. So, go in eyes wide open and, risk averse with these sorts of things. And as you said, you can't plan enough for it.
Yeah. And perhaps people, I think a lot of the time people are going in for whatever, whatever decision they're thinking about, whether it's financial, but people tend to go in with blinkers, like they've got confirmation bias, they're Googling online to, confirm what they're already thinking. But maybe if you ruled out this one, more avenues would open up that are actually better that you should be considering. It's rare that there's only one way to do something. So if you honestly think doing something with a sibling or a parent is the only way, chances are it's not. It's just what you're focused on. And if you were to shut that down, you would probably come up with some other ideas, especially if you saw a money coach, a financial advisor, a lawyer. So yeah, there's never one way to do something. So it doesn't have to be this avenue. And yeah, remembering that relationship is important.
Yeah, and I think your point there was talk to someone who's not emotionally invested in the decision.
Yeah, it's like just use it as a sounding board, right? Yeah, somebody that has absolutely no connection to the story because they can see it totally differently. Someone that doesn't know you and your life and your brother and your sister and all of that kind of stuff, yeah, completely removed, will give a totally different perspective.
Yep, yeah. Awesome.
Cool. All right. Well, that was fun and a bit messy and not a lot of clarity.
It was great chat there.
But yeah, thank you for the people that put questions through or sent them through on Facebook. And when the recording's up, they'll get to see all the answers. Well, you have a good day.
You too. Great to see you again, Gemma.
See you next time. Bye.
Bye. Yeah.